everyone, and welcome to this Community Woodlands Association session on an introduction to local democratic finance. My name's Jen Pittendrich and I'm the CWA's Communication and Administration Officer. And I'd like to introduce you and hand you over to today's speaker, who is Katie Little-Sadler from Community Shares Scotland. Thanks, Katie.
Thanks, Jen. So I'll just crack on with my slides. Yeah, my name's Katie. I am a development officer with the Development Trusts Association Scotland. I don't know if you'll have heard of them. They're a membership network focused on kind of community-led regeneration. So we work with a lot of development trusts on a really wide variety of different projects and offer a lot of different support. Within that, I'm actually part of the Community Shares Scotland team. And we are actually moving from kind of purely talking about community shares and offering support on that to becoming a bit more focused on a kind of wider democratic finance programme. So that's what I'm kind of here to talk about today, and how just the kind of different aspects of democratic finance and basically what the programme's in its very early stages at the moment, but what that will kind of mean for support for different groups going forward. So hopefully everybody can see my slides okay.
Yes.
So just a wee bit of an outline of what I'm going to cover today, and as Jen said, I'm really happy, we're a small group at the end of the day and I don't want to be kind of talking at you for ages, so if you do have any questions, just feel free to kind of put your mic on or pop them in the chat. So firstly, I'll kind of cover a bit about what we actually mean by democratic finance, why it's important, and then today I'll do a bit of an introduction to community shares, crowdfunding, and also I'll touch on community bonds. We are currently working in partnership with Scottish Communities Finance, and community bonds are their kind of area of expertise, and it's something that we are working with them on to kind of expand out to different groups. I'll focus on a couple of different case studies and then also highlight what's coming up with the programme as we develop it and as it officially launches in the spring, what's to come. So, what do we mean by democratic finance? Basically, it's where money is sourced from your community rather than having to go to an institution like a bank or a building society. And really, the programme has been developed or is beginning to be developed by us in kind of recognition that a lot of groups at the moment and going forward, can struggle to kind of acquire finance for the different projects that they want to achieve, and kind of recognising that grant funding is becoming kind of increasingly difficult to come by, a bit more competitive, and so this is a way of raising kind of awareness of different kind of financial models that community groups might want to use to fund their projects. It's a way to kind of allow your own community to invest in in your enterprise idea and your project in return for kind of social and small financial returns, which I'll go a wee bit further into detail in. And the aim overall is we want communities to kind of create their own network of citizen investors, so people who are kind of invested locally, but also that's not necessarily just on a monetary basis. That could be voluntary, becoming your customers, becoming part of your organisation by becoming members, that kind of thing. So it's really a way to kind of grow your organisation aside from creating wealth. And we also want communities to kind of better understand their local sources of wealth. So as part of the programme, and I'll touch on this more towards the end, but we'll be looking at how communities can potentially get involved with things like community lotteries, philanthropic giving, just to kind of widen their net of where potential sources of income for them or could potentially come from. How to kind of attract and retain more of that wealth, and also have more of a say in how it's actually used as well, because we think that communities at the end of the day kind of understand what's going on the ground, and what money is needed for in a way that potentially local authorities and stuff aren't always quite aware of. So why is it important? I kind of touched on this, but we recognised as part of DTAS, which I'll refer to now rather than the Development Trust Association Scotland, because that's a bit of a mouthful, kind of recognised that groups were kind of struggling to get the grant funding that they needed for their various projects. It's becoming more restrictive and a lot more competitive. We also recognise that a lot of funders and other stakeholders have expectations that actually, organisations become kind of more financially sustainable and self-sufficient, and that is also true of us as an organisation. We are also funded by the Scottish Government and various other grant funders, and they look to us, even though we offer free support and we are grant funded, they look to us to also become more financially sustainable. So it's kind of recognising that is a sector-wide issue for a lot of groups. Quite often organisations need to kind of develop more blended financial models. So, potentially a group might do a crowdfunding campaign. They might also have a kind of small scale community lottery set up. They might have, they might be running a community hub, something like that. So it's a recognition that there's lots of different ways that organisations can kind of, attract money and attract funding into their organisation. We're also seeing that community asset transfers and renewable projects are offering a lot more opportunities for local people to invest in local infrastructure. As part of the Community Share Scotland programme, we've worked with a number of hydro projects over the years that have proved really popular for those kind of citizens investors that I mentioned previously. And it's a bit of a cyclical thing wherein people invest, but that money can then come back out into the community once, say, the hydro scheme is actually making money. So it's about how we create that kind of circular economy, essentially, where money is kind of being put in, but also coming back out to the benefit of those living in that area. And it's also about working with organisations to develop more income generation approaches, because as obviously I've mentioned several times already, grant funding is becoming a bit more competitive. So how can organisations like development trusts or charities, how can they bolster what they're already doing, generate more income to become a bit more sustainable in the long term without having to rely on different various funding pots? So who are Community Share Scotland? So we are a very small team. There's actually only 3 of us, but we are part of the wider DTAS organisation, where there's about 25 people with a real wide range of skills and knowledge, which is great. So there's 3 of us, myself, my colleague Nick, who's also development officer, and Morven, who's the programme manager. And our main kind of remit is to raise awareness of alternative finance models, deliver training such as this, and also to provide direct support to communities. And I touched on this, but our support is all free, and we offer, our support's pretty wide ranging, and we always tend to be pretty flexible depending on what a group is actually needing. But it says up to 6 days of free tailored support. Generally speaking, we'll work with a group for the duration of what their community shares project or their community bonds project might be, but we can offer support around business planning, working with your community on engagement and getting them involved in the project, governance, so the kind of legal structures that you need to be, and working on your share offer document. And I'll go a wee bit further into all the kind of governance side of things in the share offer document, what that actually means. And we also offer a micro grant. So if a group wants to undertake a community share offer, for example, we can offer a micro grant for things such as a launch event, marketing, tax, legal support, and it's really useful for groups so that they don't have to kind of find their own pots of money to cover those kind of additional costs that can quite often crop up. And it's all free support. So firstly, I'm going to talk about what are community shares. So I don't know if anybody's has kind of come across any community shares or invested in any community shares projects, but essentially community shares are a way for enterprises to basically raise investment for activities or an asset that serves a community need and has a potential income generating idea. It's a bit like, we all say it's a bit like crowdfunding, with kind of community ownership at the heart, but whereas crowdfunding is very much a donation, community shares are actually an investment. And over the years, we've worked with loads of different groups, so they can be used to finance a lot of different kind of projects and ideas. So pubs and shops seem to be kind of our kind of regular kind of staple group that we work with, and we've supported a number of those over the years, and quite a number down in the borders actually. So some you might have heard of, like Broughton Community Enterprise. And now I'm talking about it, it's gone out of my head, but yeah, lots of shops down in the borders, community hubs, renewable energy initiatives like hydro schemes, food and farming enterprises, and yeah, lots of other kind of different groups. Essentially, if there is some sort of income generating idea behind the project, then it has potential for community shares to be used. So just some kind of key facts around community shares. So in order to issue shares, you have to be registered as a community benefit society or a cooperative. Generally, the groups that we work with tend to be community benefit societies, and the kind of clue is in the name essentially. It's a society wherein any of the money kind of raised by that society would basically be kind of put back into the community for community benefit. The shareholders who invest in the community benefit society during the community share offer become members, so they'll form your membership and they will have voting rights at your AGM, etc. And it really is, it's a democratic way of doing things, in the sense that someone might invest like £50 in your community share offer or £500, but it really doesn't matter about the scale of the investment that they make. They're still only getting one vote, so it keeps it really democratic, and it means that, you know, there's not a kind of scale of, if somebody puts in a lot more money, that it doesn't change things. They only still get that one vote. Shares are withdrawable, so if somebody puts money in into a community share offer, they can withdraw that after. But generally speaking, when we're kind of initially chatting to groups about community shares, the withdrawable side of things can be a wee bit of a concern initially, because obviously if you maybe have somebody putting in a more sizable chunk, say £5,000-10,000 or something, groups do tend to worry that if that is then taken out, it might leave them in a bit of a sticky situation. But there's ways around that, in the sense that you can, when it comes to your share offer document, and I'll chat through that in a few slides time about what that actually looks like, and what the purpose of that is, you can kind of set out within that that a share could only be withdrawable after, say, 5 years, and if the organisation is, making a profit at that time, and also you can stipulate that it's at the discretion of the board, and that there would maybe only be a 10% 10% would be allowed to be withdrawn every year after a certain amount of time. So there's definitely some safeguarding there that groups can put in place, if that's a concern. Investors can be incentivised through different tax relief, and we can provide support through some of our consultants on that. And investors can also be incentivised through interest. So typically that's can be quite low, between 2 and 5%. At the moment, we're probably seeing groups offering a wee bit more, just because interest rates are high. But generally speaking, what we see is that more often than not, people aren't investing in community shares projects for a large return. At the end of the day, it's much more about the social aspects of shares. So really, it is good to offer to potential investors, but it's generally, having done surveys, etc., it's generally not the reason that people do invest. And also, community shares really can help to attract further funding. So a lot of our groups are often eligible and work with the Scottish Land Fund. We've had several of our groups recently be successful with the UK's Community Ownership Fund as well. Is interest fixed? Yeah, so I think generally speaking, yes, I think groups tend to fix it, but they'll fix it maybe at the Bank of England's kind of variable base rate. So they might say 3%, but it can maybe fluctuate a bit. To be honest, again, it's kind of like with the withdrawals as well. It very much depends on, you know, how the business is functioning, what the kind of reserves are, and if the group feels that interest is actually able to be offered. I mean, I would say the programme launched in 2014, and some of our groups are probably only now starting to properly offer interest. I mean, I would say projects like the hydro schemes, where it's quite a rapid kind of, you know, they're making quite a lot, you know, a decent amount of profit quite quickly. They've been able to offer their, able to offer the share interest rate that they kind of stipulated in their share offer document, but other groups have maybe gone, we know we said it would be 4%, but actually maybe we can only offer 2% at the moment. So it's just what we always say is, when it comes to that side of things, it's about being really open and transparent and just explaining the reasons why you're maybe offering a wee bit less interest than you said you were going to. On the other hand, some groups have done really, really well and have gone, well, actually, we're going to be able to offer like a little bit more interest. So it can be kind of, yeah, very dependent on how the enterprise is going more generally. So what is a community benefit society? So a bit, or a BENCOM as it's sometimes known as. So it's a legal form for organisations that want to operate on that kind of democratic, open, two-tier membership basis. And as I mentioned before, it's a structure or a legal form that basically benefits, and the whole purpose of the BENCOM is to benefit the community as a whole. And it doesn't matter if you're a community of geography or interest or both, you can register as a BENCOM. You just have to have, when it comes to registering a community benefit society, that's something that we support with. You're registered with the FCA, the Financial Conduct Authority's Mutuals Register, and they have sorry, did I just get it's fairly lightly regulated in terms of you know, what is kind of expected from you as a group if you register as a society, but they do look to see that you've got kind of charitable objects, you know, that your aims are for a charitable purpose, and that you can kind of stipulate what you know, how it's going to benefit the community as a whole. And as I mentioned, it's kind of eligible for all major third sector funds, including the Scottish Land Fund, and more recently I mentioned a lot of groups have had success with the Community Ownership Fund as well. Also, it's also eligible for community asset transfer and community right to buy. It's not something we've actually worked with that many groups on at the moment, but it is eligible for that. There's an asset lock and it's not for profit. So the asset lock is if the you know, the essentially the society would still have to have you know, the kind of charitable aims and focus that it was stipulated at the outset as well. Sorry, my Teams is a wee bit jittery at the moment, so there we go. It can also be, you can have charitable status as well, and it's, as I've mentioned, you would be registered with the Financial Conduct Authority using model rules. So the model rules are essentially your governing documents, which would, you know, kind of set out all your kind of share offer information, all the kind of stuff around your AGMs, like basically everything that, you know, you are, you know, going to be and what you're working towards as an organisation would be in those model rules. And again, that's something that we can support with as well. Just noticing a few wee questions coming up there. So in terms of the SCIO, SCIOs are actually the one setup that's actually quite difficult to, or it's not difficult, it's just a bit more convoluted to convert. So we would usually, I think, rather than it being a subsidiary, we would usually just create like a kind of standalone kind of entity. We've not had very many groups who have come to us who are already a SCIO, but the ones that we have, I know that it's been quite it's been a bit more arduous in terms of just, you know, switching that over. So yeah, we would probably, at that point, we would probably recommend just sorry, we would probably recommend it being a bit more of a standalone thing. Sorry, just making sure I have answered the questions. And then the BENCOM. So the difference between the BENCOM and the community interest company, quite often we see it's things like, with a community interest company, there's grants or funding that you're maybe not as eligible for that you would be with a community benefit society. And it's the ability to issue the shares. Is kind of the main kind of differences that we would say would be there. Again, it's not actually a structure or a legal form that many groups have come to us in terms of already being set up that way and having to convert. But basically, the Community Benefit Society model is just a wee bit more flexible, I think, in terms of looking for grant funding. And I think even things like the tax relief for incentives that I've mentioned as well, I don't think KICs are as eligible or are able to kind of gain access to those kinds of schemes. So I think those are the kind of main differences as well. So just a wee bit about the Community Share story so far. So the programme launched in 2014, and since then we've actually worked with around 58 groups. I mean, our sort of development work is probably about triple that in terms of groups who we've worked with who then maybe haven't gone ahead with their share offer. But in total, they've raised over £19 million in share capital. They've attracted over 27 million in additional funding. And so far at the moment, we've got about 17,000 kind of community or citizens investors, as we're kind of calling them now, who've actually invested in community shares projects. At the moment, most of the groups that we tend to work with are from kind of more rural areas. And this is something that we're always trying to sort of address the balance of a little bit. And also about 20 odd groups have registered as community benefit societies using our Development Trust Association model rules. So there's lots of different model rule templates, and we work with the Plunkett Foundation, if any of you've heard of them, and Cooperatives UK, because there's different templates, and some of them are right for some groups and some of them aren't for others. But at DTAS we've actually created our own kind of specific model rules for development trusts as well, so that kind of recognising that a lot of development trusts might be set up in a way that they can't issue shares, they're not set up as a community benefit society. So this is a way to kind of create a bit more of a synergy so that development trusts can also issue shares. Again, we don't work with many development trusts, or we haven't in the past, but we are seeing a bit more of that happening now that we do have these model rules in place. And just a wee bit about the sector kind of more generally, just to kind of give you an idea of the kind of the UK-wide kind of picture. In terms of resilience, so this the Community Shares Unit, who are based down in England and are part of Cooperatives UK, commissioned a report, I think this was from last year, just kind of looking at the sector more generally, and they found that in terms of resilience, 92% of community enterprises are still trading, I think about after 5 years, with good member engagement. As I've mentioned, they're pretty successful in attracting funding, so 40 odd % of Scottish share offers have had Scottish Land Fund grant funding on, and I think about a third at the moment have had community ownership, UK community ownership funding. It's a really good way for communities to use finance to kind of tackle their own kind of local problems, essentially. And it's got quite a wide geographic spread. I think that's probably more in England and Wales rather than Scotland, where I've kind of mentioned it is a bit more rurally focused. But we were just kind of seeing that the sector essentially is growing more and more, and it's creating a really wide peer network and a lot of kind of local access to expertise. We have a really wide community shares practitioner network. I think there's over 40 odd different practitioners at the moment, all who have different levels of experience and areas of expertise. So there's a really wide network of support to draw upon. So I mentioned a little bit about, I'll just check if there's any questions. Just in terms of, Lucy, I don't suppose you want to jump in. It's just so I can make sure I kind of understand your question. Is that okay, or do you want to wait till the end, or?
Yeah, no, that's fine. Just, I mean, maybe nationally it was a bit big, but most organisations like you talked about, shops or pubs or whatever, are very local. But
Yep.
if an organisation was managing an asset which was over a larger area, like over a local authority area or something, or because in Highland we're a very big area, which is where I am. Are there many organisations that do that, or does it tend to be community shares? Are people buy in and support to local projects as opposed to something that's bigger?
Yeah, do you know, so when there's one I can think of at the moment that's a bit more national, and that is, so they are called Kubo, and they're actually part of 5pm. I don't know if you've ever heard of 5pm. So they are like a kind of online hospitality booking kind of platform, but they have now decided to become a cooperative, actually, and the idea behind them is to looking at the kind of Scottish hospitality sector and going, well, there's a lot of local, or and there's a nationwide kind of issue in terms of, say, like booking.com and things, kind of monopolising the market and charging a lot of accommodation businesses, etc., like a lot of money to advertise on their site. So essentially Kubo will become a bit like the Scottish version of booking.com. So I guess that's one that's a bit more of a national idea, essentially, and I think they are kind of launching that to the wider public. At the moment, they're just kind of trying to build their their businesses that are kind of looking to invest and get involved with it, but that will become a bit more of a national campaign in the next few weeks. So that's an example of a national one, and we've had other ones that have been kind of similar to that, but I would say probably for the most part it's local. It's more so in Scotland. I think maybe down in England there might be some more examples, particularly around, I know that there's been some examples of like larger scale, like solar farm type idea, where it's maybe a much bigger geographical kind of area that we're talking about. But yeah, I think generally speaking in Scotland it tends to be more kind of locally focused.
Thank you. That was a very good example you gave. Thank you very much.
No problem. And then, sorry, I think I just noticed that I missed one about the two-tier membership. So just in terms of that, when a community benefit society is founded, there will be that kind of initial tier of like the kind of founding membership, and you actually only need 3 founding members to kind of start off a community benefit society, and then you'll have your larger membership underneath that. So that's kind of what we mean by that two-tier structure. So just a bit about the community share offer journey. I've kind of mentioned a bit about, share offer documents and etc. So it's what that kind of all means. So basically a community share offer is like a time-bound campaign with a target amount that a group wants to raise for a very specific project. So we always kind of try and break this down into like 4 kind of pillars of what that really looks like for a group. So there's community engagement and consultation, and that's going to be going on throughout the project, right from the earliest, right from the kind of get-go, making sure that the community actually want it. What do they need? What do they want? Do they want to get involved? And that kind of goes right through the campaign from that stage to then when it launches, how you can kind of engage with the community to actually invest. As I mentioned, it's governed by a community benefit society with model rules. It's informed by a business plan, and that's something that we can support with in terms of pulling that together. And a share offer document is then created to kind of promote the offer. And essentially a share offer document is like a prospectus that essentially outlines the vision and the idea behind the project that a group is looking to fund, and the business plan will be part of all of that as well. I'll touch on this really quickly, but as an organisation, we've worked with the Cooperatives UK and the Community Share Standards Unit in England just to create the Community Share Standard Mark, and that's just a way for the network of community shares practitioners to kind of reach the kind of best practice standards for community shares. And it's just a way, it's not a it's not a stamp for investors to feel more confident in the investment, but it's just that to make it clear that all of the documents have been really thoroughly kind of reviewed and meet that kind of the standard that we would be looking for. So in terms of the share offer document and launch, again, the share offer document is something that we can help pull together, and I've just got a few wee example pictures here on the slide. Essentially, the share offer document is your kind of call to action, so it's all the things that the kind of key information in there. So you're going to have your like minimum investment level, your maximum investment level. So it could be minimum investment level could be like £50,000. It very much varies depending on the kind of project. It could be a community shop looking to raise £20,000 to make some adjustments. It could be the Glengarry forest cabin example I've given there, and I'll go a wee bit further into that when I come to the case studies. They were looking to raise £250,000, so it's a really broad range of different target investments that people are looking to raise. It'll give information like the key dates, how people can invest, whether that's on a platform like Crowdfunder or Ethics, or whether a group wants to kind of DIY that through their own website. It might include details of launch events, and then also the microgrant that I talked about earlier on can help to kind of cover the cost to pull all this kind of marketing together. So that's a kind of whistle-stop tour of community shares, and that's up until now that's been our kind of main area of support to groups, but we have been trialling a little bit more support around crowdfunding. Because we recognise that a lot of groups, they maybe don't need to necessarily raise huge sums of money, but equally they also maybe don't want the time and the kind of capacity that a community share offer can take up. There's also we recognise that a community benefit society maybe isn't right for all groups. You're maybe constituted a bit differently, and actually you're just looking to raise some money without increasing your membership and things. So crowdfunding is essentially that kind of, I know we'll all have heard of crowdfunding, but essentially it's a way of looking to people to get to invest in your project, but without having to offer a return on that investment. Maybe you just want to offer a reward of some sort, but we tend to break it down into two different kinds of crowdfunding. So there's the donation-based crowdfunding, where again, very similar to shares, people are investing because they just believe in what you're doing, and people have that kind of personal kind of motivation to put the money in, and they don't actually expect anything back. And then there's the reward crowdfunding, which is very, very similar, but you might just offer some different incentives to kind of ask people to invest. We've worked with groups who have actually done a crowdfunding campaign in addition to a community shares campaign as well, just because they recognise that maybe that not everybody wants to become an investor, and doesn't want to have that risk of putting money in that they might not essentially get back. So crowdfunding has just been a way to kind of bolster what they've been doing. And we've worked with, for example, one group that we worked with up in Noida, it was a pub group, and they did quite a successful crowdfunding campaign, and as part of that they offered really fun rewards like having your name inscribed on the bar, and things like that. So they got quite creative with it, and they were able to raise quite a lot of money through that in the end. So yeah, again, similar to community shares, I guess, the idea of why would you want to raise run a crowdfunding campaign, and essentially, yes, it's to raise money, but like community shares, what we also see is that there's much more to just raising the money. Quite often it's a way to actually get more people involved generally, maybe as volunteers, maybe they could become your customers. It can also help kind of generate kind of PR, engagement on your social media, and it's just a way to kind of get the community involved more generally and aware of what you're actually doing. It can also, if you're able to raise, and I think this is a point that I didn't maybe touch upon, but I think we see with community shares and with crowdfunding that it gives that kind of confidence to invest it to funders as well, in the sense that if they can see that a community is actively engaged and actively really wants this project to happen, they themselves will be more likely to get involved as well. So at the moment, the microgrant is mainly just for community shares. I think we are looking to kind of expand that, but at the moment we're still kind of waiting on our own kind of funding to kind of come through to kind of expand the democratic finance programme, wherein hopefully we might not be able to offer the full £5,000, say, in terms of the microgrant, but hopefully we'll be able to offer maybe half of that or something, because I think the misconception about crowdfunding is almost that it's like an easier option, or it's it maybe doesn't involve as much work, but actually a crowdfunding campaign can be quite time consuming, and it still involves quite a lot of, you know, engagement and work on the behalf of the organisation. So I think, you know, recognising that, we know that in terms of marketing, etc., it's not always something that you're going to have budget for, so it's certainly something that we're going to be looking at as well. So just in terms of kind of managing the crowdfunding campaign, and this is very similar to, you know, looking at a community shares campaign as well, it's all about that kind of initial planning, you know, making sure that you've got a marketing plan that's quite clear, making sure you've got people and time and resource to actually implement it. And this is a really good chance to kind of utilise any volunteers and board members that you have, and we always say that in terms of community share campaigns as well. It can be quite a long process, and it, generally speaking, is much easier for a group who has a bit more time to actually invest in it, and has, you know, either volunteers or board members that are willing to invest their time and their skills and be willing to pick up the phone to ask people to kind of donate that money, or have one-to-one meetings with people, that kind of thing. We also kind of set achievable targets, so you know, if it's a small scale project, you need to be realistic that you're probably not going to raise £100,000 necessarily. But again, so it kind of depends on what your project is in terms of, you know, and that's something that we quite often can advise groups on, is, you know, is this a realistic amount that we're looking to raise, and, you know, how you can kind of get the kind of key information that you need on your crowdfunding page, and what has worked for other groups that we've supported, and that kind of thing. In terms of rewards, I think I mentioned that some groups do offer that, but I think we always say just to be a bit cautious in terms of, are they achievable? Are they time consuming? Are they costly? It's really good to kind of weigh all that up and actually look at, you know, as an organisation, what can you actually, you know, time wise, etc., resource wise, what do you actually have time to fulfil? Quite often with things like crowdfunding, they offer some match crowdfunder. They actually offer some match funding, so it's worth looking at that. And be prepared, if you are going to run a crowdfunding campaign, to have a kind of FAQs page, because quite often people have a lot of different questions, and it's the same for community shares as well. So just a wee example of a crowdfunding campaign that we supported a group with. So Scotland the Bread are based in Fife, and they are a collaborative who basically work to grow better grain and make better quality bread, and kind of more aligned with how it would have been before kind of ultra processed bread and things came on the market. They were looking to raise about £25,000 to take on another member of staff to basically develop their a programme, a kind of additional programme to what they were already doing. And their campaign ran for about 6 weeks, and then they left it open for further donations. So I think in terms of the timescale with what they managed to raise, they did really well. And yeah, as I mentioned, they used that to kind of further their community engagement and education projects. They offered quite simple rewards from kind of £5 upwards, and they did receive a kind of small grant towards marketing costs from us as well. So that was quite useful. That's just a bit of an example of their actual crowdfunding page. So last kind of area of democratic finance that I'll focus on today, and we are hoping to run some more sessions over the next few months as the programme develops, particularly initially around kind of philanthropic and legacy giving as well. But yeah, community bonds are another way to raise investment from your community, and we are working at the moment with Pauline Hinchin, who is the Director of Scottish Communities Finance. She's very much the bonds expert, so if this is something that you'd be looking to discuss a bit more than happy to put you in touch with Pauline as well. But essentially, They are similar to community shares in that you have to be a community benefit society registered with the Financial Conduct Authority, and it's all about, very similarly to community shares, it's about raising that kind of affordable, patient, as Pauline likes to call it, finance from within community groups. And essentially, with community bonds, essentially they are in terms of the difference, actually what I'll do is I'll skip to this page. This is probably an easier way of, that's not so text heavy. In terms of the differences, so with community bonds, it's debt finance essentially, and it's, whereas with community shares, you get members invest, become members or shareholders and have voting rights. With community bonds, that's not the case. It's to say similar in terms of, you know, do investors get their money back? Yes, but with caveats that I mentioned. For shares, there's caveats in terms of, you know, longevity of when you can maybe say groups will get shares, or shares will be withdrawable in terms of when they'll get their interest back and things. So the kind of big differences with community bonds, investors do get their money back. So whereas with community shares, it's a bit more, you can, you know, create that kind of safeguarding. With community bonds, because it is debt finance, you basically have to stipulate that it will be within a certain time frame that somebody will get their investment back. You do have to be registered as a community benefit society, but the relationship that we have with Scottish Communities Finance means that essentially they are set up as a community benefit society. So if a group didn't want to necessarily convert to do a community bond offer, Scottish Communities Finance can essentially act as the community benefit society to issue the bonds for a group, and the group would essentially pay back Scottish Communities Finance over a period of time. And again, it would be very similar in the sense that it wouldn't be, you wouldn't be expected to pay the money back the year after. It would be, you know, if you were profitable after, say, 5 years or something like that, that would all be kind of stipulated in your kind of community bonds document or prospectus, which is again very similar to a community shares prospectus as well. Just see if there's anything I've not covered here. That's quite a good point, actually. So you can do, similarly with shares, you can actually do more than one share offer. So we've actually, in terms of with community shares, we've had groups who have done one share offer and then maybe a few years later have done one again, and it's the same with community bonds. There's not really a limit to how many you can do, essentially. So that's something we're seeing now. We've actually, now that a few groups, you know, since we launched in 2014, maybe did their community share offer several years ago, they are now kind of looking to expand or you know, redevelop a space or something like that. They are able to do another kind of community share offer or a bond offer, essentially, to further kind of their aims and develop what they're doing as well. So I'll just chat through a couple of case studies. So this is a community bonds case study, and essentially this was for Linlithgow Solar Cooperative, and they are a development trust who were basically looking to put solar panels on the roofs of various sports facilities in the local area, and they they did a initial kind of first phase to basically, I think it was one sports facility they managed to raise the finance to put the solar panels onto, and they managed to save all the clubs that they worked with over £900 in terms of their electricity costs. They managed to generate some surplus income, some surplus revenue for the community, and so now I think they've done 2 community bond offers, and they're now about to do a third, so that will be a lot larger kind of in size and scope, and I think the overall ambition is to kind of take it beyond the sports facilities within Linlithgow and actually work with some other local organisations to implement more solar panels on the roofs there as well. So now, kind of as a result of that, I think because they have been on the go and doing these community bond offers for a number of years, they've got a really kind of strong network of investors. They've been really quite successful and quite proactive in terms of their community engagement to actually kind of grow that network as well. And I think they are roundabout in a position where they can start to kind of offer people a bit more of a return on that investment, in addition to the fact that they're also generating that kind of surplus income that's going back into the the community development trust as well. And I'd put this Glengarry Forest cabin. Sorry, just noticed a couple of wee questions in there. So in terms of the tax relief, yes, yes, there is, and that's the same for shares as well. And I mean, it can kind of depend on eligibility, and I think the schemes have kind of seem to be changing a wee bit all the time at the moment. But we work with a tax advisor, or we can bring in a tax advisor to kind of support groups to kind of offer that a bit more kind of focused support. Basically, we always call it support. Pauline is very clear that I say it's support, not advice, because we don't give advice on tax relief. We offer support, so make sure I get that in there just in case she brings it up with me. And then in terms of the difference, that's actually a question that I'm not entirely sure about in terms of the difference between the bonds and loans. So Jim, is it okay if I maybe come back to you on that one if I refer to Pauline? Thanks. And then Glengarry Forest Cabins. I'd put this in because obviously this is part of the Community Woodlands Association event, so I thought this was quite a relevant one. So, and this is a really good example of a group who had kind of recognised the issues that were within their community. So essentially they were having real kind of historic and kind of ongoing issues with affordable housing, local jobs, local employment. So they had taken ownership of their local woodlands a number of years before, and they were already using that to do things like supply firewood to kind of domestic and commercial use. They run like a forest school, so doing lots of different activities from that, various events. But they kind of wanted to use the woodland for something more, and they wanted to, generate a bit more income, basically to go, how can we use our woodland to raise money to solve some of the bigger issues that we're having within our community, which is the kind of affordable housing and the lack of kind of local employment and things. So through a feasibility and a kind of community consultation, they realised that one of the best ways for them to generate that income kind of going forward and for the longer term was to create a ecotourism business. So in a kind of, not a challenge to the kind of Airbnb market that existed in the area, but as a kind of way to provide something a little bit different that would also benefit the local community. So back in 2022, they launched a community share offer which raised over £270,000 from about 176 investors, and actually they managed to raise a good percentage of that from the local community. I mean, it's worth mentioning that, for a raise like that, a group wouldn't necessarily always be able to just raise that from their own community. It's very much the case that, some of that money would need to come from out with the community, and especially if you are applying for Scottish Land Fund funding and you're doing a community share offer, they will often stipulate that the split of local ownership versus ownership out with has to be about 51 to 49%, and that's just to keep that real kind of local democratic kind of control, so that there's not kind of too much outside investment. So the plan for their kind of vision was to create 5 off-grid eco cabins, which would be, you know, holiday accommodation, kind of tapping into the really busy kind of the fact that they're a really busy tourist area, and that the cabins eventually will provide a kind of sustainable income for them going forward, and that'll enable them to create things like affordable crofts, and hopefully it's going to create some local jobs, and it's going to enable so Glengarry Forest Cabins are another example of a development trust who are linked, so they've used their model rules to kind of link the two. So they'll be able to put money back into the development trust once they're up and running and making a profit. So they're a really, really positive story. The cabins are kind of not quite up and running, but they will be by the spring, and hopefully they will start generating an income relatively quickly. And lastly, if you're still awake, just a wee bit about what's next in terms of our democratic finance programme. So it is quite early stages. Community shares are definitely our main area of expertise, but as I said, we're working with Scottish Communities Finance around the community bonds aspect. We're looking to branch out in terms of our crowdfunding support. But in terms of where we're at the moment with research and development of other areas and other kind of models that might be suitable for communities, is around legacy and philanthropic giving, and we'll be doing a session on that in the next few months. Community lotteries, common goods assets and funds, community benefit funds, and community shared ownership of things like offshore and onshore wind. And basically it's looking at how can we support groups to gain more access to these things. You know, there's potentially millions of pounds in community benefit funds out there for groups, but how do they access it? Potentially if you're maybe not in a particular postcode. Community shared ownership of renewable energy schemes, how can communities potentially tap more into that? Legacy and philanthropic giving, how can groups maybe create, you know, there might be individuals within their community who are looking to put something in their will, looking to you know, contribute to their local economy. So how can that maybe potentially happen for groups? So it's just looking at lots of different facets of how groups can kind of raise that alternative finance essentially for their projects. So yeah, there'll be lots more to come on that over the coming months as the programme develops as well. So yeah, I think that's me. Thanks very much for listening. I feel like that was quite a long time of me talking at you. If there's any questions or additional questions.
Katie, thanks for that. I'll turn off the recording now and then we can have more questions.